The global economy is riding high on the artificial intelligence boom, a technological wave that's transforming industries at a breathtaking pace and capturing the imagination of investors worldwide. It's a frenzy some call a modern gold rush, as fortunes are made overnight and the race to stake a claim in the AI revolution intensifies. Billions of dollars are pouring into AI startups and established tech giants alike, propping up global stock markets and fueling a sense of wild, almost feverish optimism. Every company wants in on the action, and investors are scrambling to catch the next big thing, driving valuations to unprecedented heights and sparking fierce competition. The promise is enormous. AI will revolutionize everything, from medicine and healthcare to transportation, finance, and beyond, creating untold wealth and reshaping the way we live and work. But beneath the excitement, a question lingers. Is this truly a sustainable new era of prosperity, or just another fragile bubble waiting to burst? As money floods in and headlines tout the next breakthrough, hype and speculation often blur the line between genuine innovation and wishful thinking, making it harder to separate fact from fantasy. History reminds us that when everyone believes they can't lose, that's often when the real danger begins. So is this miracle built to last, or are we repeating the mistakes of the past? If this feels familiar, it's because we've seen it before, most notably before the 1929 crash. Back then, new tech like radio and cars sparked a similar mania, with stocks soaring 90% in a year. Easy credit and speculation let ordinary people gamble with money they didn't have, fueling a bubble. Today, trading apps and social media hype make speculation easier than ever, with AI startups valued on dreams, not profits. The lesson: when prices are driven by hype, not value, the fall can be sudden and brutal. No matter how revolutionary the technology, financial gravity always wins. After the devastating crash of 1929, lawmakers and regulators scrambled to build financial guardrails, determined to prevent another economic catastrophe. Sweeping reforms were put in place, designed to protect not just the markets, but the livelihoods of ordinary people. These new rules aim to shield families and workers from Wall Street's wild side, ensuring that the reckless speculation of a few wouldn't devastate the many. But today, many of those hard-won protections are being quietly dismantled, often out of sight and with little debate, even as speculation and debt surge to new heights. The pitch from industry insiders: looser rules mean more people can join the so-called wealth party, opening doors that were once tightly shut. But these rules weren't arbitrary. They existed for a reason: to keep people from losing everything on risky bets they don't fully understand, and to prevent another wave of financial ruin. The push to let average investors into private markets, once reserved for the wealthy elite, ignores the real dangers lurking beneath the surface, where losses can be swift and severe. For every celebrated AI unicorn, there are thousands of startups that quietly fail, wiping out the savings of hopeful investors who believed in the dream. Weakening these safeguards is like telling people it's perfectly fine to bet their life savings at the casino, where the odds are rarely in their favor. The result? A recipe for personal financial disaster on a massive scale, threatening the security of families and the stability of our entire economy. Powerful voices like BlackRock's Larry Fink want retirement funds to invest in risky private assets and AI startups. The argument: higher risk, higher reward, and everyone deserves a shot. But this is people's retirement money, not play money for venture capital. Policy is already shifting, letting 401ks chase volatile returns in private markets and even crypto. The rise of meme coins, worthless assets pumped by social media, shows how easily hype can turn to ruin. Sorkin's own Sorkin coin soared and crashed in days, a digital echo of old-school scams. The line between opportunity and exploitation has never been thinner. After studying the 1929 crash, Sorkin's warning is clear: a reckoning will come, it's just a matter of when. History has shown us that markets can soar to dizzying heights, but they can also come crashing down with little warning. The lessons of the past are not just stories. They are cautionary tales that echo through every generation of investors. Bubbles are hard to spot from the inside, but they always burst. The signs are often ignored until it's too late, and the consequences can be devastating for those caught unprepared. The same greed and fear of missing out that fueled past manias are alive in today's AI and crypto frenzy. The excitement is palpable, and the promise of quick riches draws in crowds, just as it did in every speculative boom before. Weakening financial protections in the name of fairness is playing with fire. Regulations exist for a reason. They are the guardrails that keep the system from veering off a cliff, even if they sometimes seem restrictive. Guardrails weren't meant to stop people from getting rich, but to keep them from losing everything. They are there to protect not just individuals, but the stability of the entire financial system. Betting retirement funds on the next big thing may seem exciting, but it's a dangerous game. The thrill of chasing the latest trend can quickly turn to regret when fortunes are lost in a flash. A boring, diversified approach is still the safest path to financial security. Spreading your investments across different assets may not make headlines, but it's the surest way to build lasting wealth and peace of mind. In a market that feels more like a casino every day, prudence is more important than ever. The timeless lesson is clear: slow and steady wins the race, and wisdom will always outlast hype.